So, you've been told the only way to get cash from your Bitcoin is to sell it, right? That's the story the old financial system loves to tell. And why wouldn't they? They win when you sell. You get hit with a tax bill, you lose your spot, and you kiss all that future potential goodbye. But what if there's a different way? A strategy they don't really talk about that lets you get cash from your Bitcoin today without selling a single Satoshi and without inviting the taxman to your party? Stick around, because I'm about to show you exactly how it's done. Let's have a moment of real talk. Have you ever sold some Bitcoin only to watch the price go on a wild run just a few weeks later? Drop a comment if that's you, because man, that stings. You sell because you need cash, and maybe for a house deposit, a new business venture, or just because life happens. But when you do that, you hurt your long-term wealth in two major ways. First, you trigger a taxable event. The second, you click sell. The taxman magically appears, hand out, ready to slice off a piece of your profits as capital gains tax. If you've been holding for a while, that can be a painful amount of money just gone. Second, and maybe this is the bigger one, you give up your seat on the rocket ship. You're no longer holding what many of us believe is the single best performing asset of the last decade. Now you're just standing on the platform, watching the train pull away, hoping you can buy back in cheaper later. And we all know how risky that game is. This is the classic problem for any long-term holder. How do you use your Bitcoin without losing it? For years, it felt like you had to choose. But finance is evolving. The light bulb moment is realizing you can treat your Bitcoin just like the wealthy treat their assets. They don't sell their real estate portfolio or stocks to get cash, they borrow against them. And now you can do the exact same thing with your Bitcoin. So what does borrowing against your Bitcoin even mean? Let's break it down, nice and simple. Imagine a normal loan, but instead of using your house as collateral, you use your Bitcoin. You find a lending platform, you deposit your Bitcoin with them, and they give you a loan in cash, or more commonly, a stablecoin like USDC that's pegged 1-to-1 with the US dollar. Your Bitcoin just sits there, locked up securely as collateral while your loan's open. The important part is you still own it. You get the cash to do whatever you need, buy a car, invest in something else, pay off a credit card. All the while, you're still exposed to Bitcoin's price. If Bitcoin moons, you get all of that upside. Once you're ready, you pay back the loan plus interest and you get your Bitcoin back. Simple as that. It's an incredibly powerful way to get liquid without messing up your long-term game plan. Now, there are a few key terms you absolutely have to know before you even think about doing this. The first is loan to value, LTV. This is the big one. It's just the ratio of your loan amount compared to the value of your Bitcoin. So if you have $10,000 worth of Bitcoin and the platform offers a 50% LTV, you can borrow up to $5,000. Because Bitcoin's price can be a roller coaster, these loans are always over collateralized, meaning you have to put up more than you borrow. This is how the lender protects themselves. The second is interest. No surprises here. You'll pay interest on the loan, which can be fixed or variable depending on the platform. You've got to shop around. And the third, most critical term, is liquidation. This is the monster under the bed, and we're going to talk a lot more about this later. So why jump through these hoops? It really comes down to two massive game-changing benefits. First, and this is the one that makes people's jaws drop, you don't trigger capital gains tax. Taking out a loan isn't a taxable event. The IRS sees it as debt, not income. So if you're sitting on $100,000 in Bitcoin with a monster unrealized gain, you can pull out, say, $40,000 in cash and pay zero capital gains on it. That move alone can save you thousands, maybe even tens of thousands of dollars. The second major win is that you keep all your exposure to Bitcoin's potential upside. This is the hodler's dream, right? You get the cash you need now without selling the asset you believe in for the long haul. If Bitcoin's price doubles while you have your loan, that's your gain. You just pay back the original loan amount plus a little interest and you get back Bitcoin that's now worth way more. You didn't miss a thing. Put these two together and you have a financial strategy that really separates the smart investors from everyone else. You get cash without the tax hit and without giving up on future growth. By the way, if this is starting to click for you and you're having a bit of a light bulb moment yourself, do me a quick favor and tap the like button. It really helps the channel and gets this info out to more people who need to hear it. Okay, so you're on board with the idea. Where do you actually go to get one of these loans. You've basically got two main roads to choose from: centralized finance and decentralized finance. Think of CeFi platforms as the banks of the crypto world. These are companies like Nexo or Ledn. The process here feels a lot like opening an online bank account. You sign up, do the whole KYC, know your customer thing, deposit your Bitcoin and ask for a loan. It's usually super user-friendly and the cash shows up fast. The good: it's easy for beginners. You have customer support to call if you get stuck, and the apps are generally slick and simple. The bad: you're trusting a company with your Bitcoin. This is called counterparty risk. If that company goes bankrupt, and we all remember Celsius and BlockFi, your crypto could be gone for good. It's the classic not your keys, not your crypto problem. DeFi is a totally different beast. These platforms aren't run by companies, they're run by code. Smart contracts on a blockchain like Ethereum. Think of protocols like Aave or Morpho. Here, you never hand over your crypto to anyone. You interact directly with the code using your own wallet. To get a loan, you'll usually need a wrapped version of Bitcoin, like BTC, that can live on Ethereum. You lock your BTC into the smart contract and borrow stable coins against it. The good: you're in control. No company can run away with your funds. The whole system is transparent because every transaction is public on the blockchain. The bad: it's way more complex and definitely has a steeper learning curve. You are your own bank, which means you're also your own customer support. The main risk here is smart contract risk. A bug or a hack in the code could put funds at risk. The choice between CeFi and DeFi really comes down to what you're comfortable with. CeFi is convenience over control. DeFi is control over convenience. This all sounds amazing, but I'd be doing you a massive disservice if we didn't talk seriously about the risks. This is not a free lunch, and if you're reckless, you can get wiped out. The number one risk, without a doubt, is liquidation. Bitcoin's price is volatile. If the value of your collateral crashes, your LTV ratio shoots up. Let's say your $10,000 of Bitcoin drops to $7,000. Suddenly, your $5,000 loan has a much higher LTV. If it crosses the platform's liquidation threshold, say 90% LTV, the platform will automatically sell your Bitcoin to pay back your loan. This is a forced sale at the absolute worst time, a market bottom, and yes, that is a taxable event. You lose your Bitcoin and get a tax bill for the privilege. To avoid this, you have to watch your LTV like a hawk and be ready to add more collateral or pay down the loan if the price starts dropping. The second is platform risk. We touched on this. With CeFi, it's a company going under. With DeFi, it's a smart contract getting hacked. No platform is bulletproof. Do your homework and only use reputable, audited platforms. There's also rehypothecation risk. This is a fancy word for when some CeFi lenders take your collateral and lend it out to other people to make extra money. It adds another layer of risk. If their bets go bad, you might not get your Bitcoin back. Look for platforms that offer non-rehypothecated loans where your collateral is kept safe. The good news is this space is getting smarter. We're seeing new models emerge, like loans with dynamic interest rates or even 0% interest loans on some DeFi protocols that are designed to be more resilient to liquidation. But for now, you have to be obsessed with managing that liquidation risk. So you don't have to sell your Bitcoin to tap into its power. By using it as collateral, you can get cash for life's big moments, all while sidestepping a huge tax bill and keeping your seat for the next big run. It's a strategy that turns you from just a passive holder into an active manager of your own wealth, using the kind of tools that used to be only for the super rich. But it's not risk-free. You have to understand LTV, be vigilant about liquidation, and choose your platform wisely, whether you go for the ease of CFI or the control of DeFi. This isn't financial advice, but it is a look at a powerful option that the old guard doesn't want you to know about. The power is shifting back to you. So what would you do with a Bitcoin-backed loan? Buy a house, start a business, or maybe even leverage up? Let me know your ideas in the comments below. And if you want to keep learning how to build and protect your wealth, make sure you're subscribed. I'll see you in the next one.